Hey, what's up guys? John here. What's happening right now in the housing market says everything, especially in the eyes of private equity and deep-pocketed investors. When the housing market, they say, is extremely volatile, with private equity accounting for 33% of all home sales. 33% of all home sales. A lot of people are anticipating a housing correction, a market crash, but there's so much money on the sidelines waiting for great deals. And I believe that the deals that they're going to be targeting are going to be the residential $200,000 to $400,000 single family entry level homes, because they're going to have pricing power when it comes to renting out these properties. And they're borrowing money at rates in which, a lot of people would find desirable, even 5 or 6%. Getting those loans over 30 years fixed is very attractive, but many of these investors are getting discounted rates, discounted to a level that most everyday Americans couldn't get access to. Here's what's going on. First, Adam Neumann of WeWork, he's just raised $350 million from Andreessen Horowitz. $350 million, now his company is valued over $1 billion, and they want to go out there and buy up tons of rental properties all throughout America. And we have Blackstone prepping for a $50 billion vehicle to scoop up cheap homes during the downturn. $50 billion. Now, to put this into context, the average median home in America is $428,700. And they were to put down 20% down on every single one of these properties, it would be $85,740 per home, which would account to 583,000 single family homes if they were to buy them at the $428,000 entry level price point, right? That is substantial. 583,000 homes. Here's what their plan is. Residential real estate is arguably the best valuable and accessible segment of real estate asset classes. Popularity has driven a disproportionate amount of capital into residential real estate, particularly from institutional funds, pushing up valuations and pushing yields lower. Real estate investment giants continue to buy up homes, something that is likely here to stay, even with higher mortgage rates. In fact, Blackstone is close to finalizing what could be the biggest traditional private equity real estate investment fund in the history. Right? In the history of the world. According to Wall Street Journal, in a regulatory filing last month, Blackstone said it has secured $24.1 billion of commitments for the latest real estate fund called Blackstone Real Estate Partners X. Combined with Blackstone's real estate fund in Asia and Europe, the company will have over $50 billion available for opportunistic investments. In the event of a market downturn, Blackstone will have plenty of capital to scoop up attractive real estate bargains. Now, what I think they're going to be doing here, because we're hearing about and seeing about mortgage companies going under, banks just shutting down, certain arms of the mortgage lending division. What I think they're going to do is I think they're going to start knocking on, Wells Fargo, Bank of America, knocking on their door saying, you know what, we know that you have $20 billion in bad loans. We're willing to write you a check for 12.5 or 15 billion, and we will take over all the responsibility of these loans, right? This would make sense for them because the banks would have about 6% in transfer fees, whether it be 5% for a realtor, 1% transfer tax plus holding costs, utility bills, everything that they're going to be responsible for, property taxes, while they try to sell these properties off one by one. And they don't know how deep this recession could be, right? So it would make sense for them to try to strike a deal with a Blackstone or a KKR or one of these large institutional buyers at pennies on the dollar, right? And that's why I believe they're positioning themselves well to scoop up a lot of property. Earning decent returns isn't easy when you have to compete with Blackstone's big guns. Low single-digit yields are tough to swallow in an environment where interest rates are rising and inflation is at 8.5%. Real estate investors need to look beyond residential properties. Here are some niche REITs that offer returns, right? Healthcare properties, Omega Healthcare Investors, cannabis warehouses, innovation industrial properties, mortgage REITs, Starwood property, right? There's a bunch of opportunities, but Blackstone has that brand and reputation and the deep pockets to run out there and scoop up a lot of deals. Now, what I wonder is what is going to be the big opportunity for everyday investors? I believe the big opportunity is going to be making sure that you know where you're investing, you are pre-approved, you're qualified, you're ready to buy a deal. Last thing you want to do is rent a property from a large institutional buyer. Because why? Well, because they're going to continue increasing rents much more dramatically than an everyday mom and pop investor would. And they're likely going to be taking away amenities, whether it be parking, charging for laundry, charging for, everything that they could possibly charge for, they're going to charge for. And you're just going to be another, everyone is just going to be another renter to them, just another number, another tenant, right? Whereas a mom and pop landlord, they actually would, know you by first name. They would try to help you, try to work with you. They would try to, be compassionate, right? It's going to be a different game when these deep pocket investors step forward. That's why I think it's very smart right now to understand the direction that the real estate market's going in and to build out a plan and a strategy to position yourself well so that, you never, put yourself in a position to rent from a Blackstone. No offense to Blackstone. Blackstone, they've done tremendously well. They have about $1 trillion in assets under management. But would I want to personally rent from a large corporation? No, definitely not. I personally would rather own my own real estate and have my own control of my own property and my own life. What do you think about this entire situation? Where do you see this situation going? I think we are stepping into a renter nation. We're already kind of there. But as we step into a downturn and we start seeing more layoffs and inflation getting out of control and all these problems happening, people are going to be forced to rent. Many people are going to be forced to rent. What are your thoughts? Drop below. Let's talk about it. If you need help fixing your credit, maybe your credit score is holding you back from starting a business or getting approved for a mortgage, visit cashnow.video. That's cashnow.video. My team of credit repair specialists, they're absolutely incredible, and they would love to help you and work with you at cashnow.video. You want to learn about real estate investing? Cashnow.video. You want to get on the YouTube grind with me? Cashnow.video. I believe some massive changes are going to be coming afoot very, very soon. I actually believe that these rising mortgage rates are a blessing for a Blackstone or for one of these private equity companies. And why would that be? Well, a couple of things are happening. One is that you're going to have rising rates that are going to impact cap rates, and people that are in adjustable rate mortgages, you're going to have these people being impacted to where they're not going to be able to, service their debt. They have rising property taxes, rising insurance rates, and rising mortgage rates on an adjustable rate mortgage. These people are going to need to make changes. You're going to have a lot of people that bought multifamily property over the last couple of years, and they bought these properties at a 4.5% rate or a 4%. Commercial loan, right? And now what's happening is they're going to be entering an era in which they could have higher vacancies, rents are starting to fall slightly in some markets, and they're having higher carrying costs. And so when they go to try to refinance these properties to get a new loan at the expiration of their 5 or 7 year arm, they're going to be in trouble, right? Because cash flows are going to be falling and their costs are going to be rising. And so ultimately, a lot of people could be upside down in these buildings, leaving a huge opportunity for these institutional investors to step out there and buy up those properties as well, right? So I believe that the ultimate move for an everyday renter right now would be to look at a duplex or a triplex or a fourplex if you can find a great deal on one and put yourself in one of those units, rent out the other units, put yourself in a good situation. And the great thing there is that you'd have 30-year fixed rate debt, right? 30-year fixed rate loans associated with those properties, whereas 5 units and above, you would have to refinance those properties later down the road. You take on a little bit more risk, and you need some more cash. With a fourplex, you could probably buy that with 3.5%, 5%, 10%, 20% down, whereas 5 units and above, you might need 25% to 40% down. Right? There's big opportunity. It's a little bit more complex than what I just laid out, but the overall view is that there's going to be a lot of opportunity with mom and pop investors. They're going to need to sell, and if you're renting right now, that could be a really great entry point for you inside of those units. What do you think about it? Drop below. Let's talk about it. Hit the like button, and catch you guys in the next video.